Hey everyone, welcome to Uber's quarterly report update to shareholders in Q3 23 with focus on what's in the business model, starting with financials as always. Well, really good numbers across the board, across the key metrics. Monthly users update increased by 15% year on year, trips increased by 25%, gross bookings by 21%, and revenue by 11%. So revenue didn't increase quite as much as the user and usage figures, but we'll see one of the reasons in the next slides, and also just check out our update for the last quarter where we discussed some of those reasons. So here we see then by segment, mobility growth 31%, and delivery 18%. So that's also one of the reasons why or let me say these ones are the reasons why revenue and usage figures didn't grow in lockstep. So first here, if you notice last year, Q3, ironically, gross bookings across mobility and delivery were at the same dollar figure, and that had to do with delivery catching up a lot at that time, and still during COVID, delivery and mobility shrank and delivery grew. But now it's really going at two different speeds, literally. But it is delivery is a space where Uber is aggressively innovating and pushing in. So we do see that the delivery business is a harder business because basically instead of a driver and a consumer, there are now the restaurant or the merchant, let's say, and the driver on the demand side who want to make money. And there's the consumer who wants to pay as less as possible. So that's why there's kind of also demonstrated in the take rates here, 28% take rate on mobility and 18% take rate on delivery. Still both figures, I think, pretty good, and certainly the 28% on mobility is very good. Then cost structure. So direct cost or variable cost have grown pretty much in lockstep with revenue growth, approximately 10%, which it's not surprising, obviously, but you'd still hope with scale that direct costs grow a bit slower than revenue, in particular if they are such a large proportion of revenue. On the other indirect costs, or fixed or spread costs, they have, like here, sales and marketing has even gone down in absolute terms, let alone as a percentage of revenue. So their reliance on advertising has reduced, and general and admin as well as depreciation amortization, that may have to do with kind of running a tighter ship during COVID and at the back end of COVID. So if you don't invest as much in technology, then you have less to depreciate in the following years. This number certainly will go up going forward, and they've been certainly investing a lot in their delivery platform. Now, balance sheet, maybe we spoke about it last time, maybe just check it out, the video to Q2. Basically what we'd called out is that these numbers are pretty high as a proportion of the total asset pool, goodwill being a somewhat arbitrary or hard to measure asset, but the percentage of the total asset pool is reducing as the total assets figure is increasing. And the other one, also probably just calling it out for the last time, I'm hoping that at the Q4/annual update, we'll get a bit of an update on these and the background. But yeah, certainly what we had seen already last time has increased a lot, but that also certainly has a lot to do with the number of trips has increased by 25%. The insurance reserves have increased by 40%. So not quite in lockstep, but the number of trips increasing and number of drivers increasing certainly are explanations. And let's see if we get an update at the annual update. Now, business model updates. So key economic and strategic highlights. As mentioned, number of trips grew by 25%, number of users by 15%, which also means there are more returning users, and that's a great news story. That's what you want to have as a business. Retain customers and increase their usage. Then supply side, active drivers up by 32% year on year, and their supply hours increased by 5%. So it's not just let's not use a negative term, but it's not just marginal or bad or whatever drivers, with the supply numbers going up as well, that's pretty. It's a good news story. It does lessen their reliance on financial incentives, and here we've calculated the monthly earning across all geographies, which has gone down by 2.5%, and certainly the increasing supply side and supply hours is the main explanations thereof. And yeah, so it's that. Business model canvas, which is a little bit of a summary of all the updates in the canvas. So let's move on. Mobility business. Yeah, on Uber Taxi, so has launched in New York City and LA. And they're saying those that have accepted Uber X trips have an average 24% more income than those who didn't. Well, yeah, let's see what happens there. The pressure is on the taxi drivers, I would think. And then increasing level of differentiation on the non-Uber X products. So that is one way of growing the business. It's now generating 9 billion in annualized bookings. Remember, approximately 35 billion in this quarter, so just to give you a proportion. But the growth rates are very healthy. And nevertheless, it makes 13% of the mobility gross bookings. So that's not nothing. It's a very good number for non-core business revenues. And certainly these will grow. Yeah, they called out Uber Moto and Auto as two of the cheaper options. And in India, as an example, potentially a fast and large growing market, represented 40% of all trips. They're not telling us the important number, which is all trips. What does it make up in terms of gross bookings? But yeah, there's still an interesting update. They're also saying 40% of those who take one of the cheaper alternatives go on to take other mobility products. So it is a channel of customer acquisition and growing the addressable market. Very interesting playbook tactic. Like us if you like us, please hit the like button. Continuing on. So this is a long-term theme. The employment status of the drivers been probably one of the most debated hot topics of Uber from the early days on. So now we are seeing, so as you know, there are some jurisdictions where Uber was forced to, they couldn't any longer classify them as contractors or independent contractors. Now they have to be classified as employees, and therefore is a business model change, as you call it, and the impact thereof in mobility is 0.9% or 90 basis points. So at a take rate of 28%, I think no regulator will feel sorry for them. But it's not nothing, and I mean, it's just a few jurisdictions that have decided on that finally, like London/UK and a few others. And yeah, if everyone was to decide that the employment status is to be an employee of the company, it would certainly eat into this figure a lot, and even more so in delivery. Here, the impact is 2.2% on the margin, at a margin of 18.2%. So that could be an impact. They have final determination in the state of New York, where the Attorney General as well as the DOL have basically decided that, yeah, they are either classified as contractors and they can obtain unemployment benefits. So, yeah, this speaks a language, and it's a win for them in those jurisdictions. But I think the state of California has made a final determination and not looking that favorable currently, but we'll see what happens there. And like still many other jurisdictions on the line. And delivery, no longer just eats, as just check out our last quarterly update where we've given you a lot more details around this particular vertical, or let me say around this business segment. So the strategy is to grow verticals like grocery, convenience, and alcohol, etc. 16.8 billion in gross bookings in this quarter and a growth rate of 18% therein. But we have seen that the take rate is it's very good, but it is also a lot lower than the take rate on mobility. Revenue grew by 6%, well, much lower than the 11% across mobility. They're expanding their customer segments. Well, I don't know what you think about it. I mean, for starters, sadly enough, like that's the SNAP is the food stamp program. Unfortunately, sadly, those demographics are growing. They're large and growing. So in terms of size, it is some demographic there, but whether it's a very lucrative demographic, that's something else. But anyway, it's an update that they want to let us know. More important probably is the AI-powered conversational shopping experience, which can help all customer segments, in particular here in this case across the delivery, product choice, and other kind of easing the ordering process. And moving on, delivery highlights on the supply side. They haven't provided this time around the growth rate of active merchants, so it's just a few highlights. You can read through those. I think, just a few large companies that have joined as merchants. And Uber Direct, we have also said something last time, so that's the white label offering of Uber Delivery. Basically, Uber does the delivery, but it is not shown as Uber. It is shown as the company that, it's a white label. So the company that is partnering with them is shows as the delivery partner, as the delivery company, and not Uber. Then, important, I think this is important, cost structure and efficiency. Delivery times have reduced by 3 minutes. That could be in the vicinity of 10%, so that's pretty significant, I think. And cost per trip decreased by 5% through technological and operational improvements. So that is something for sure. Then they're saying solid progress on reducing order defects like missing and inaccurate items, etc. That's, I think, important in terms of cost, but also in terms of customer defection and stopping that. Here's the app. We've spoken about it the last time. Here's the kind of the services and delivery stuff. There's lots behind it. If you haven't looked at it, take a look. It will look different for different geographies, but take a look. And I spoke about it the last time. Our premium products, check out our store, digitalbizmodels.com. Entry level, but in half an hour you can learn the business model, and super duper affordable. This is our super affordable offering to get you started in literally half an hour with a video and a BMAP business model on a page. And then we've got case studies. We've got the sharing economy case studies covering Uber, Airbnb, and WeWork. And we like to compare those that haven't been successful with those that have been growing very fast, because we can learn from both. So check out great products there. Subscription revenue and loyalty. So Uber One, now they have exceeded the 50 million members. They launched in 3 more countries, and basically literally a story of geographic expansion and some exclusive offers, which I haven't listed here, but that's fine. And advertising, pretty much the same. They're growing geographically, 70% year-on-year growth, which is not surprising. It's a relatively new offer. And basically, if you want to read through this, they're basically some of their value propositions and offerings growing in certain markets. That's the story there. And so freight will skip. Maybe at the year-end update, we'll say something about it. It was certainly a disappointing year for freight. Autonomous vehicles, the key update here was finally they launched their Waymo partnership, where you can hail the autonomous ride in Phoenix via Uber. And that's certainly a partnership. It will take time to scale, but there's certainly a very promising thing there. And on the other hand, also very scary for drivers also, but that comes from the AV direction. So here in one chart, everything that we're giving you an update on this time around. And disclaimer, we are not giving you any investment advice. None of this was meant to be or is investment advice. And check out our T's and C's as well as our website. You will find a lot of great stuff, free and premium products. Thank you very much.